Okay, good. How's weather in Islamabad, Malia?
So it's almost spring here. We're almost approaching summer. Towards the summer.
Okay, great. So we'll go through. My name is Anjum Satar. I'm teaching with Raman with the UK Versity last 3 years, and I'm teaching in Oxford University as well. I taught various sort of courses across ACCA, management courses, ATHE and OTHM, and various other awarding bodies like ATHE we have here, and I'm teaching, used to be teaching the University of Cumbria as well. So currently my role in Bradford University and Bradford College. And plus I'm teaching with Raman normally on weekends. So if you have any question, if you not get me, please ask me. I'll try my best to meet your expectation. Okay, Daniel, we'll recap what we learned during our last lesson. Malia, then we'll start. Daniel, anything do you remember we learned during last lesson?
No.
You not remember we learned about the sources of finance?
Yes, financial.
So where we can get the money from? How we can raise it?
Bank loan and
Well done, bank loan.
yeah, many ways. There are many ways.
Yes, we discuss about equity financing shares, company can issue shares.
Yes.
We discuss about mortgages.
Sorry?
We discuss about lease, finance lease and operating lease, hire purchase agreements.
Yes.
Okay, I'll send you the recording. You have recording on Moodle as well. Just try to go through again, please. Okay. So because of course you have to write your assignment as well. So if any question, if you not get me, ask me, please. Okay. Welcome everyone. We'll start our second lesson. So before starting, do you have a learning outcome? What we're supposed to learn? No? Amalia, are you aware of, where we have a Moodle, you can access all the resources?
Yes, I'm completely aware of that thing. Apart from that, I was going to say that we already taught learning outcome 2 from Sir Raman last week. When
Yes.
class. So we just started learning outcome 2. We have to start from learning outcome 3.
Yes, I'm doing learning outcome 3, and learning outcome 2 is all about the sources of finance.
Yeah.
So just 1 second, I'll show on Moodle where the things are, so you can access as well. Now why my computer is running slow? Okay, I'll go through with you. Okay, we'll start our lesson first. I'll go through later on with you. I'll show you the learning outcome. Okay, so today we're going to learn about, my aim of this lesson is Introduction to Investment Appraisal, which is part of LO3, which is Learning Outcome 3. Let's talk about NCV which is called Payback Period, Net Present Value Method, and IIR, which we'll go through. We'll go through very basic because it's a level 4 course, and we just need a basic concept of these. And do some extended activities to enhance your understanding about investment appraisal. Okay, what is meant by appraisal? Anybody knows what is meant by appraisal?
No, sir.
Amalia, no? Daniel, what is meant by appraisal?
I don't know.
Sir, this very vague definition of appraisal. Like, so,
If we are working end of the year, all the employers normally do appraisal. In some countries called annual confidential report. Yes, that's the end of the year appraisal. Appraisal means checking the performance.
mm-hmm,
Appraise it. Appraisal.
mm-hmm,
Investment appraisal, it means we are going to check the performance, the pound or the money we'll spend, how much money we will generate against it.
mm-hmm.
Based on the financial information. Whatever financial information we have, we'll appraise it and we'll see, whether is it good to be invest in particular project or not.
Mm-hmm.
Malia, are you working?
Yes, sir. Sorry?
Are you working or you just, you just studying?
Not at
Do
the
you
moment,
work
I'm
as well?
studying. No, sir, right, I'm just studying.
Okay, what you done before?
A-levels, and then I was a college dropout.
Sorry?
A-levels, and after A-levels, I got into university, and I dropped out. So it's like now I've continued with my private education this way.
Okay, that's fine. Welcome. So, Malia, let's we'll go through. So, I wish today we'll learn about and we'll achieve our objective. So, you well aware of what these terms stand for: NPV, ARR, EBP, which is called payback period, IAR, internal rate of return. So, we'll go through at least 2 methods out of 4, and you're supposed to be well aware of what is meant by investment appraisal. Break even point. Anybody heard about break even?
Yes, sir, it's a point where there's no profit, no loss.
Yes, Daniel, break even, what is meant by break even?
I don't know.
Okay, break even is a point where no profit, no loss. Break even is a point where no profit, no loss. Okay, we'll go through definition of investment appraisal. Investment appraisal is a business concept which consists of future income to be derived from our investment. Simple, we just looking what we will invest and what we'll get out of it. That's it called appraisal. Yes? Can anybody heard about Bitcoin?
Yeah.
Already heard about it.
Is it good to invest in Bitcoin?
No, sir, I don't think so. Since it's just a virtual currency.
Yes, cryptocurrency. So if we'll invest in cryptocurrency, what are the problems? Is there any problem?
It's the exact valuation of that currency. Since it's not in physical form, it's just a virtual or cryptocurrency. It's really hard to actually recognize its importance and its value out there in the in other countries or in the wider economy.
Brilliant. So the value of the currency is such a risky. It goes in thousands. It goes into zeros. Yes.
Yeah.
So it depends, because that's it called investment appraisal. Is it good to be invest? We can earn more, but we have to be at some risk as well. It's a high risk. So we can appraise either we'll invest in cryptocurrency or we'll deposit money in the bank. So bank will give us just an interest, but the interest will be very low, but low risk as well. But if we'll invest in in cryptocurrency is a high return but high risk as well. Let's we'll go through next. These are the investment appraisal method which we'll go through. Payable period, discounted payback, net present value, internal rate of return, sensitivity analysis, how the project is sensitive, is it how much is change happen, break even is a point where no profit, no loss, accounting rate of return, how much money we'll invest and how much return as a percentage we'll get. So, okay, time value. Before doing anything appraisal, we need to understand time value of money. If I'll say to you, give me 20 pounds and I'll pay you back 20 pounds after 5 years. Is it good?
No.
Why not?
Because the value of money is gonna change. It might depreciate or it might even appreciate. We do not know what will be the exact status of that specific currency. It does not have a fixed value.
Yes, Daniel, if I'll get and is it Korean? Which currency yours? Daniel, which currency you have? Is it called yen or is it called Korean currency? What's the name of your currency?
Sorry?
What's the name of your currency? Currency mean money. How we call, is it dollar? Korean.
Won. WON. Won.
Okay. So, what do you think? Is it the value of your currency against dollar increase or decrease? Is carry on increasing?
Sorry,
Is
I
carry
don't
on
know.
change?
No, maybe
The
not. No.
But value always change, yes?
Yes.
So always interest cost. If you're giving money to somebody and someone will say you will get some money back after 5 years, if I have 20 pound today and the 20 pound after 5 years, it won't be the same value. That the reason due to the inflation, the purchasing power of the currency dropped. So that's why we need to look around. We need to find the real value of the money. Real value mean what I'll get it, what will be actual value I can buy it. It makes sense, time value of money. So if I'll say to you 10% is annual interest and I lend £1 and after 1 year if you give me £1 back, that £1 value will be only 91 pence if I'll depreciate by 10%. Okay, we use the formula or we use the table. It's called discount factor table. So I'll give you table. At this level, you don't need to use many formulas, but formula is 1 divided by 1 plus R. R is equal to discount factor. So if I'll say 10%, so 10% means 0. How we can write 10%? It means 0.1, yes?
Yes.
Instead of R, I can write, if I'll do 10%, I can do 1 divided by 1.1, yes? Because 1 is in formula and R is my discount factor which I'm using 10%. Can you divide 1 divided by 1.1? We have a calculator, or you can use calculator in here. What value will come?
Just a second.
Daniel, if you divide 1 divided by 1.1?
So 0.909.
Yes, so we can, if we'll do 3 decimals or 2 decimal, we can say 0.91, or we can call 0.9. Yes.
Yes.
So this way, and whatever answer will come, we'll carry on dividing with denominator figure, which is 1.1. After 1 year will be one value will be 0.91, and it will divide whatever answer will come, will carry on getting, it will be second year supposed to be 0.82 something. Yes. So it means the £1 value after 2 years will be 82 pence. So in this way, if you'll take the longer to recover the money, the value will be lower. Question, you getting?
Yes, sir.
Okay, we'll move next. So first of all, we'll go through payback period. If I'll invest £10, how long will it take me to cover my £10? That's called payback period. 2 years, 3 years, 4 years, whatever, and that's called payback period. Which we'll go through. We'll go through the question, will make you more sense. So, what do you think?
Hello?
Payback is? Can you hear me?
Yes, sir.
Daniel, can you hear me too?
Yes.
So first of all, advantages and disadvantages of payback period. Payback period is very simple to use. Use the payback period method. Second, I can say I'm investing. I will say, oh, my £10 will recover in a year or 2 years. So that's very easily understandable. Whatever you will invest in a business, how long will take you to cover your money, your investment? Like you investing in education. So if you get the job, maybe it takes you few months to recover what you invest, or maybe it takes a bit longer. But education investment is not going to be end, it carry benefit out of it. Yes. So this is one sort of investment as well. So we need to look around, assist with the cash flow. Is it good because it will help me, the money I'll invest, how long it takes, to get the money back. Technology. If I'll invest in Apple iPhone or in Samsung company, I'll buy shares because technology so rapidly change. If my pay is long to cover my investment, maybe technology become outdated. So this method will help us to decide which company I will invest. I'll go through examples with you next slide. But what are the disadvantage of this method? Is a problem disadvantage. If I'll say £10, £10 back, I'll get £12 in 2 years. But actually, what will be the value of £12 after 2 years? If in some country high inflation, maybe value will be very less. So this method don't consider the value of the money. Is only consider what you invest, what you get back. Because real value could be very less. Any question?
No.
Daniel, any question?
Yes.
Yes, any question? Your question?
No.
Okay, I give you example here. Payback period. I'm going to invest £3,100 in a business. Cash flow mean in a bracket you will see this is the money going out from my pocket. I'm investing. Yes. This is money is going out from my business, I'm investing it. So my figure is a negative because I have invested money £3,100. Year zero mean my current year, the year when I'll invest. Does it make sense?
Yes.
After 1 year, I will get £1,000 back. So if I'll get 1,000 back, how much is outstanding money?
2100.
£2,100 still outstanding to recover. After year 2, I'll get £900 back. So my money left to recover £1,200. So difference between positive and negative, yes?
Yeah.
And we cumulative mean total, yes? Cumulative cash flow mean total cash flow. So year 3, I'll get £800 back and will be only left to cover my investment £400. So I know this project will take 3 years and some months to cover my money, which is £3,100 I'm going to invest. So in year 4, I will get £500. How much I supposed to recover? £400. I'm getting more than this project. So I'm getting is outstanding to recover the money is £400 end of year 3. So 400, the following year the money I'm getting 500 times by 12. How many months in a year?
12 months.
12 months in a year. So give me the time period 3 years and 10 months. So this project will take me to recover my money if I'll invest it and 10 months. What do you think? Is it good? If you invest in 3 years, your money will be back. Then you will carry on getting money. That will be your profit.
Yeah, it's fine.
Okay, good. So that's all about. It's called payback period method. We call investment appraisal payback period. Any question?
No.
No.
I will send you some activities with the template with the answers. So exactly the same way you can do, please.
Okay.
Okay.
Yeah.
Next is called discounted cash flow. Discounted means the money I have now, the money we'll get after 1 year, it won't be the same value. In real world, always the money, the value of the money, that's called discount. We can discount it because there are a number of, how much inflation we have in Pakistan?
It's pretty much increasing each year. I'm not just aware of the exact inflation rate, but it's increasing each year.
Approximate how many percent, if we'll say in percent? Is it 5%, 10%, 2%?
I think it's pretty much more than that.
In Pakistan, around 5+%.
Yeah.
Yes, depends which industry. Daniel, how much inflation you have in your country? Inflation mean increasing the prices.
I don't know.
Maybe approximate 3 to 4%, according to my thought, because I need to do. If you go online, you can find, the World Bank always publish the information, each country. In UK, we have 2.9% now inflation due to the Brexit, because of course UK is outside European Union, so very high inflation now we have. So that's we need to look down. That's why we need to use the discount factor may be higher than if I'll borrow money, what interest rate I can get from the bank, or how much I have to pay to the bank. All these factors we need to consider to decide which discount factor I'll use. Okay, I'll go through. Okay, this method have advantages and disadvantages. No method is a perfect method. If sorry about, I'm not feeling well, so my voice a bit. So every method have own advantages and disadvantages. So pro and cons. That so this investment appraisal method have a direct link to the shareholder wealth, time, money. But this method is difficult to explain. If I'll say you £1 won't be the same value after 1 year, so it's very difficult. How much will be drop the value in real world is very difficult. Yes, there are so many factors we need to consider. So that's why this method is difficult as well. But this method have an advantage because it's telling us the real value of the.
나 방금 서치하는데 안 나와, 엄마.
Okay, you okay, Daniel?
Yes, sorry.
Are you okay? You getting me, huh?
Yeah.
Okay, so I'm using NPV method. NPV stand for, anybody knows NPV?
Yes, sir. Discounted cash flow.
Discounted cash flow we call net present value. What will be my net value of the money which I'll get? Okay, so you don't need to worry. I'll send you the table which is called discount factor table, where will be given the value. I'm discounting this by 10%. I'm using discount factor 10%. So I'm going to invest 20,000 in business. Year 0 mean current year. So 20,000 value will be 20,000. It mean £1 value will be £1. Yes, in the year when I'll invest it. So 20,000 times 1 is giving me in third column 20,000, because the money I'm putting negative sign with it because that money is going out of the business. Does it make sense?
Yeah.
Okay. After 1 year, I'll get £5,000 back, which is a positive, the money coming in the business. But 5,000 value, if I'll discount by 10%, so the 5,000 value will be £4,545. Actually, won't be the real value 5,000. In real world, I'm not getting £5,000 back. I'm getting £4,545. Even in my hand is 5,000, because the 5,000 value will be equal to £4,545. Does it make sense?
Yes.
Year 2, if company pay me back 7,000 and £1 value at that time will be 82 pence around. So my £7,000 value will be 5,782. Year 3, if I'll get £8,000 back, so £1 value will be 75 pence. So I will get £6,008 back. Can we add all these positive values and we'll do minus negative? Let's try. So how much is money going out of the business? Do positive figure, add positive and minus negative. So 4545 plus 5782 plus 6008. It's coming, my positive figure is 16,335 pounds. And how much I invested? It's about 20,000. So still I have outstanding amount to recover. Negative figure 3,665 pounds. Okay, this is my NPV. What do you think? I'll accept the project, I'll reject it.
Reject it.
Reject it. Reject it, because the reason is my NPV, when my NPV negative, I'll reject the project. Okay, this way we can calculate. It's called NPV. It's called net present value method. So I'm going to reject it because the reason is my NPV, my calculation came, my negative figure is still, I'm not recovering the money which I'm going to invest it, which is 20,000, and I'm getting real value of money is only 16,665 pounds. So, but that's not covering the real value of my money. So I'm getting less, really. That's we need to look around. Any question?
No, sir.
So this is called payback NPV. I'll send you some activities with the answers so you can look around as well, please. Okay, next method we'll use is called ARR. ARR is consist of average rate of return. What ARR? Is called average rate of return. I put the formula there, is called average profit per year divided by initial investment. Average profit, how much average profit I'm getting each year, and how much is my initial investment. How much money I'm investing. So I'll give you example in next slide that will help you to clear. So we have 3 projects. Handover, Bristol and Carlisle. These are the 3 projects. I'm investing, if I'll go for the project A, I need 4 million investment. If I'll go for the project B, I need 4 million. If I'll choose the project C, I need to invest 5 million. So these are year 1, year 2, year 3, year 4, 5. After 1 year, I'll get 1 million back in under the handover project, which is a project name. And in 5 years, I'll get how many million? If you add them all, million. So I'll get £1 million back in 5 years. So what will be my average profit? So which will go through how much I'm investing per million, how much I'm getting 5 million, my profit is 1 million. 5 minus 4 is 1 million is my profit. Then this 1 million I'm getting in how many years? In 5 years. So 1 divided by 5. So I'm getting average profit 0.2 million each year. So if I'll divide 0.2 divided by 4 million by 100, I'm getting only 5% profit. As a percentage, I'm getting 5% profit of my investment. So exactly the same B. In year 1, I'll get 1.5 million. Year 2, I'll get 2.5 million. Year 3, I'll get 0.5. If we'll add all, this 4 million, I'll get total 5 million. 5 million minus 4 million, I'll get profit 1 million divided by 5 in 5 years. I'll get 0.2 million my average profit. If I'll divide as a average profit divided by my initial investment, which is 4 million. So again, I will get 5% return. In project C, I get any return in year 1. Year 2, I'll get 0.5 million. Year 3, I'll get 1.5 million. Year 4, I'll get 2 million. Year 5, I'll get 3 million. So when I'll add them together, positive and minus negative figure, 0.5, 0.1, 0.15, this will 2 million. 2 plus 2 is 4, and 4 plus 3 is 7. 7 minus 5 is 2 million. So 2 divided by 5, I'll get 0.4 million. 0.4 divided by 5 million times by 100. As a percentage, I'll get 8% my return. Which project you will invest?
C project.
C project. Daniel, you getting? Yes, we'll invest
Yeah.
in C project because C project will give me my 8% return on my investment.
Yeah. Right.
So, but what is the problem with C? Is there any problem with C?
Well, there's just one problem, like one or two problems, but at the end of the day, it has the greatest average profit.
It has a greatest average profit. You're absolutely right. But we need 5 million investment as well. If I don't have a 5 million, what I'll do? If I have a 5 million, I'll go for the C. Otherwise, maybe I'll choose between A and B option. If I have 4 million.
Yeah.
Does it make sense?
Yeah.
So in this case, I'll go for C if I have a 5 million pound investment, and then I'll go for the project C. Any question?
No.
So,
Okay, this is called ARR method. Okay, I put the quiz for you as well to do practice. You want to, we'll do quiz. Because this is a slightly bigger learning outcome. So maybe we'll spend a bit time, next lesson as well on it. No problem with my computer today is running. Should be fast. Technology, never know. We had a snow today, so internet connections and things. Okay. Okay, anyway, if we can't, I'll send you the recording of this lesson as well. Huh? So you guys, because sometimes we do a bit, lesson, because we have to cover, all the learning outcome. So if you not get anything, you can ask me and try to just re-listen. And okay, 1 second. Okay. Come on. Oh, sorry. Maybe it's a bit, page. Okay, I'll link later. Okay, I will do the quiz next lesson, at the start of next lesson, to recap on it. Okay. So next we moving. So we'll keep these three methods, and break even we'll go through next lesson. So yes, I'll go through one more with you. Okay, what is meant by budget? Anybody?
Budgeting it's kind of a process in which you think about spending your money in the upcoming time period.
Okay, yes, good. And why will make budget?
To plan out our expenses.
Good. Okay, so if we don't make budget, what are the problems?
We might lose out some money.
Yes, we all have a limited resources. We have unlimited wants, desires, and to fulfill our desire, we need to make a budget. We need to prioritize which activities and where we'll spend the money and how we'll spend it. So always is good to make a budget, and we need to go through the budget. And budget is very, very crucial thing. If we don't have a budget, don't make the budget, we could be out of money. Okay, so we'll go through a bit, about budget, because within LO3, we're supposed to discuss about the budget as well. So budget is a financial plan. Budget helps us where we are, where we want to be, and budget provides a guidance about the future. So every country make national budget, every company make budget. So if we don't have a budget, we don't know the things, then. So that's why budget, always we need to make a budget. Okay, we'll go through the budget. Okay, budget is a plan expressed in a financial or other quantitative term which extended forward for the period in future. Budgets are widely used in all types and the size of the business, and it helps us to plan and control. What is meant by control? In business, control is important. Hello?
Yeah.
Control means the corrective actions. Yes, what we supposed to do, what we did. We always check, we are according to the budget or not. If we're spending more, less, we have a variance. Variance is a difference between the budgeted and actual expenses. Okay, types of budget. What type of budget we can prepare is a sale budget. Sale forecast will help us to make all budget. If I'm saying how many handsets of mobile phone we can sell next within a year, and we can make our production budget, how many units we supposed to produce. Then we can make our labor budget, how much labor required to produce it. Then we can make our material budget, how much material required to produce the unit. And the material purchase and usage budget we can based on the production budget. And we can make the cash budget. Cash budget mean how much money will be coming and how much money will going. So we can make the cash budget. These are all the types of budget. Budget is a financial plan where we are, where we want to, and the budget help us to plan and control. and we can make different types of budget: sales forecast budget, production budget, labor budget, material budget. Budget will be defined as a precise target. Cash receipt and payment could be our budget. Sales, stock. Budget allows planning. It helps us to coordinate between departments. We can give them different departments in a budget, like HR budget, production budget, manufacturing budget, and we can communicate. Budget helps us to motivate people. If they perform within a budget, they will say, oh, it's wonderful, and they can get performance related pay. Control is a corrective measure, and we can evaluate their performance. So all is a part of budget. Budget could be set. It could be yearly budget, it could be quarterly budget, it could be short term, long term, and medium term. So budget could be different times. Budget could be continuous, predict budget. So I'll send you these slides to read what is meant by budget and how we can. Anybody heard about limiting factor? What is meant by limiting factor?
It has something to do with these budgeted profits and loss accounts. It's the basic calculations that we make.
Limiting factor mean the limit. I have only 400 labor hours available. I have only £1,000 cash. I have only 20 kg of material. These are all the limiting factors. Yes, we have a limit. So we need to try them to utilize effectively to maximize our return on investment. Yes?
Yes.
So these are called limiting factors. Okay. When we have a budget, we can look around the way what we budgeted, if I'll budget, I'll buy £3 per kg material, but actually I paid £4 material per kg. So there will be a variance. Variance is a difference between budgeted and actual. So which I'll go through more details next lesson, because I have to do one more lesson on same learning outcome. Okay. So I'll send you these stuff. Okay, I'm going to send you some questions. Like here, I'm going to send you the question about the budget and the solve questions that will help you, because basically in your assignment, when you write, you can write and you can add the example of budget. So that's what we need to do. Okay, so what we learned up to now today? Anything you remember?
Cash flow.
Yes, we learned cash flow. What is meant by appraisal? Appraisal. What is meant by appraisal? It means checking the performance. Yes. Investment appraisal means the pound we invest, how much we'll get, and we'll do to check the performance. Okay. So we'll do this question. I'll send you some with answers as well, with template. So we have a sales in these months. We have a purchase. We have a wages, salaries, and expenses. And this 50% we'll receive from our customer. In the month, I need to go through this properly with you through using the template. Just a matter of filling the template. I'll send you this template. Please, if you not get things, don't worry, because we need to go through.
Yeah.
Okay, like I'll send you the template where we are putting, which month, how much we have a sales, and purchases. Yes, so you can put the figures of purchases there. How much percent will make the payment in the January, in Feb? So you can carry on putting these. You can put the wages. Yes, but these been solved on the next template as well. So you don't need to really. Yes, we'll see there is already solved. So when you look the question, so I'm saying 82,000 worth of the sale as we have, and we'll receive 50% in the month of the sales, and rest, and we'll give them 10% discount as well. 50%, 90% of the remaining money. So that's why the different figure in the following month. So we'll carry on doing. So you read the question and look these template all been solved. Okay, and I'll go through during next lesson with you. Okay, so what we learned today. We'll recap and we'll finish then.
Okay.
So our target was to learn and to understand what is meant by investment appraisal. We know investment appraisal is a technique to measure the performance of the money we will invest. Yes, in simple words. Or is a business method to appraise of investment. Okay, NPV. What is NPV stand for? NPV. Malia, what is NPV? Daniel, what is NPV? The word NPV stands net present value. When my value is positive, I'll accept the project or reject it. When positive value will come, we'll accept it. When negative value, we'll reject it.
Yeah.
Okay. What is ARR? It's called average rate of return. Malia, are you there as well? Okay. What is ARR? It's called average rate of return. Okay. What about next? PBP, which is called payback period. Payback period method, which is lower payback, is always better. And break even is a point where no profit, no loss, which we'll go through during next lesson. So next lesson we'll go through budgeting. We'll prepare one cash budget and we'll go through break even, the unit cost, and the margin and the profit. So that's what we'll do. So please, these slides I'll send you. I'll upload on Moodle, putting in the order, and then you can go through these slides, please. Okay?
Yeah.
Okay.
So just go through what are advantages and disadvantages of payback period. Look this example again, which we did of payback period. Go through example of one NPV, and I'll send you some templates and we'll do more activity during next lesson. Okay, so just you read what is the NPV, what is meant by payback period, and what is meant by ARR, and what is meant by budget and budgetary control, and how many types of budget we prepare, which I gave you. I mentioned you sale budget, cash budget, yes, production budget, and budget means the financial plan. So any question? We'll finish lesson today then.
Yeah.
And we'll start. Any question, anyone?
Yep.
Also.
Okay, please, if you have a question, ask me, and hope I will see you next lesson then. In between, my email will be on the slides. you can drop me email. It's my name, Anjum at ukversity.co.uk. So you can send me email as well, please, if anybody any question. Okay, Daniel?
Yeah.
Oh, you have a lesson tomorrow as well?
Yeah.
So I'll see you tomorrow then, huh? Tomorrow I'll go through the remaining part. Okay? I'll go through tomorrow other remaining parts with you.
Professor, could you please upload these slides on Moodle?
Yes, I'm going to upload these slides on Moodle, and plus, I'll send you the recording as well. Recording will be on Moodle as well.
Okay.
So, of course, maybe this topic sometimes takes a while to better understanding, but go through yourself. I'll explain you tomorrow again, and you will be there, huh? Or we all will be there, and we'll get what we do. Okay. Have a nice day, and I'll see you and speak with you tomorrow.
All right. Thank you. Bye.
Right.